Okay.
Okay, so maybe we'll get started, and then as I introduce you, there are more people coming in.
Perfect.
Okay, hello everyone. So welcome to the Actuarial Science and Financial Mathematics seminar. Today we have the pleasure of having Marco Mirabella from Ensuro. So Marco is the founder and CEO of this company, Ensuro, which is a DeFi insurance company developed on blockchain. And he's I would say, a serial entrepreneur. And so he was previously with a venture capital company at the beginning. He's an investment analyst, and then he went on to found a number of companies, right, including Katasi, BeatGo, and now he's with Ensuro. So I had the pleasure of meeting him in the past, and then he has great enthusiasm for DeFi, and he set out to change the world with his new DeFi company. So without further ado, let me pass on the floor to Marco, and we'll be very excited to hear what you have to say about the space.
Awesome. Thank you for the introduction, Professor Feng. So today I will talk about blockchain in general with an introduction about of Bitcoin, and then I will dive deeper into the decentralized finance space with a focus in the reinsurance insurance space, with more of a practical perspective. So we will actually try some of the DeFi protocols. Okay. So Bitcoin. How many of you are using cryptocurrency, holding cryptocurrency, or interacting with any DeFi protocols? Yeah, so I assume nobody use the DeFi, so I'll go from the basics, and then we can do from that. So Bitcoin is creating a new digital cash. And today, I want to give an example of the idea behind blockchain and how we get there from a general idea of a communal ledger. So we can take as an example the friends from Family Guys, that they generally go and drink beers and food and eat food at the drunken clan. And as part of their being there, they decided to keep a ledger of their transactions, to keep account of who owns what. So in this case, we have Peter that pays Quagmire, Cleveland pays Joe pays Peter, and the different type of amount. Now, in this type of communal ledger, we can imagine that everyone can add a line. So each one has access to the communal ledger, and then they can write transaction. But one problem arises. So if the people involved in the communal ledger don't know each other, then there's a possibility of someone writing some fraudulent transaction inside the ledger. So, and this will go against the entire community. So the people from the Family Guys, they decided to add a signature in their transactions. So whenever Peter makes a transaction, next to the transaction performed by Peter, you can add an actual signature. That in this case is a analog signature or in paper. There is, however, a similar concept in the digital space. That is the digital signature created by the private and public key. So each member of the communal ledger, each member of this community will have access to a private key that is connected to a public key. And this represents a signature in the digital world. And this type of private and public key have several benefits. They can be, compared to the private key can be a password, and the public key can be an email. So by having a public key of someone, I actually can send transaction to that someone, but I won't have access to the private key because it's having access to the password of the users. And the good thing about this private and public key function is that I can sign a message with a private key, and then I can verify having the message, the signature, and the public key, whether or not that is true or false. So I can know that Peter, with his private key, signed a message. I can create a signature, and then with the signature and the public key of Peter, I can actually make sure that Peter is the one that signed the transaction. So this is a particular feature that it's quite relevant in the Bitcoin space. So the friends in the family guy client, they decided to implement this. So together with the transaction, they put the signature with this digital signature, so they make sure that whoever signed, they can be proved that is that specific person. However, what problem arises here? So let's suppose the people in this communal ledger, in this community, they record the transaction with the US dollars, but then they don't want to pay each other. So one solution for this is to replace the US dollars and assume that the value inside the ledger as a value. So it's that the currency or the units inside the ledger has a certain value. So we can take rid of the US dollars in this case and replace it with Bitcoin. So Bitcoin is essentially the unit of value inside a communal ledger that enables people to pay. So in this case, they replace the actual physical cash and give a certain value to the Bitcoin and as a way to perform the transaction among a certain community. Another problem arises though. So you have this communal ledger that the people from Family Guy decided to store in the bar, in the drunken clan. However, this creates a problem. So if you have a single ledger and the owner of the bar hates the guys, then they can burn the ledger and cancel all the transaction. So blockchain and Bitcoin in general mitigate this problem by maintaining a ledger for each individual and participant in the blockchain. So each person will maintain a ledger. In this way, you have decentralization. If someone loses the ledger, you can create a copy, and that person you can continue to have this registry of transactions. And we call it distributed ledger because it's connected among each other. So you can have a transaction, and the people in this distributed ledger, they will update their own ledger with the transaction that they hear from others. And here comes another problem though. So if you have people that are located in different places, let's say Peter is in US, Quickmeyer is in Russia, and other people are located in different parts of the world, it comes with a problem that there's a time to propagate that type of transaction. So it's difficult to keep track of every single transaction and have a single communal ledger that it's shared among everyone. And it comes we can introduce a concept of a hash function here. So I can take a message file and then create a hash function and then get a digest. And the good thing about this hash function is that it's irreversible. So from the message, I can derive the digest. From the digest, I cannot derive the message in a simple way. So in this case, and the good thing is that the message, different messages have, even if I change a little character, in this case, ciao mama, if I change that a little character, the entire hash changes. And this is a key feature in the Bitcoin infrastructure. So I can take the ledger of every, so Quickmeyer, Peter, and all the participants, and then I can add at the bottom of the ledger unknowns, which is a random number that the people input inside their own ledgers. Then I calculate the SHA-2056, and I derive a number that there's a random number. So even if I change a little parameter, the amount of a transaction, whoever performed the transaction, the signature transaction or the announce, the number that will derive, the digest will change completely. So the Bitcoin protocol adds a very interesting thing here. that they call complexity. So the complexity, it's represented by the numbers of zero that are in the output of the SHA-2056. So I can put a different type of zero and make it more complicated for the miners. And in this case, are represented by ASIC machines for the Bitcoin network. So machines that are designed to do very simple calculation in a very fast, performing in a very fast way. So I can continue to complete the SHA-256 until I get a certain number that has a particular, predetermined numbers of zero at the beginning. If I find that type of number, I mine the block. So it means that I can propagate it among the entire network, and I say, okay, guys, I find this this block, and my version of the communal ledger is the most updated one. So everyone will redo it. And it's difficult for other people to do the same because they will need to spend a lot of energy and computational power using the miner devices in order to do the same. So that's solve the issue with a decentralized ledger and the issue of propagation of a transaction. So, and it probably it's one of the key feature, the key invention of Bitcoin. And then you might ask where the name blockchain come from. So you have the different type of ledgers, and then the top of the ledger, at the first row of the ledger, what you do is that you insert the previous block hash. In this way, you actually perform something very interesting. If you modify the hash, if you modify any type of information inside a previous block that it was confirmed, so propagated and find the block with a certain complexity, I go and change this, I will change completely the SHA-2056, and then I will change the block hash. So that is the header of the other communal ledger, and I will change the entire blockchain. So blockchain derives from this concept here. So it's a chain of blocks that are connected with each other using this characteristic that are connected with each other by this SHA-256 that is located at the bottom of the ledger. And Bitcoin also adds another feature here. So Bitcoin rewards people with Bitcoin. So each time I find a certain ledger, so I mine a block, meaning I find the digest or the output of the SHA-256 that enables me to have an output with a predetermined set of zero. I mine a block, and I can input as a first transaction of the block the fact that I can transfer to me the numbers of Bitcoin that are preset at the beginning of the epoch. And the numbers of Bitcoin, so the numbers of Bitcoin issued by this methodology is decreasing over time. It started with 50 Bitcoin, then it halved with 25 Bitcoin, 12.5 Bitcoin. I think right now we are at 6.25 Bitcoin. And this is every 4 years we'll have until it will be insignificant the amount of Bitcoin that will be earned by this concept of mining. And for this reason, the inventor of Bitcoin figure out this type of problem and enable the people that propagate a transaction to add a certain fee for the miners. So the miners not only will get a block reward, but also will get a certain portion of the fee whenever a transaction is propagated. So I want to remove a myth that I've been hearing many times, that it's blockchain is the future, but cryptocurrency are a scam. So you can see here that cryptocurrency and blockchain are interconnected with each other. So you need an economic incentive that enable to coordinate a group of people that don't know each other. So if you remove a cryptocurrency from a blockchain, then you actually don't have a blockchain anymore. So that's a myth that I've been hearing many times. So if you get the Bitcoin, like we have a new digital cash that is decentralized, that is transparent, and has a fixed supply. So they call it the trust machine. There was an article some time ago in The Economist, call it like that. An application, a simple application of this is that if you go and check the Swift So there's the way like people send money with international settlement. The SWIFT system enables banks to interconnect with each other. So we have two members of the Family Guy system that they want to send money on from a country to another, from Nigeria to Russia in this case. So you will have a bank located in Nigeria that has a bank account in another bank located in Italy, for example. There is another bank account that is located in Germany. There is another bank account that is located in Ukraine. There is another bank account that is located in Austria. And what the SWIFT does is essentially intermediates this type of connections within the different type of banks, and is an extremely inefficient system. So in fact, if you're ever trying to send a transaction, an international transaction from your bank in US, you will likely to pay like $50 or more if you want to do something like that, plus the fee, the Forex fees. Now look at the counterpart. So with Bitcoin, you have a QR code that represents the public address of a certain individual. And instantly, through the Bitcoin network, that is a decentralized network, and nobody controls that, you're able to send money and value directly to another person in another part of the world with a fraction of the cost. And in fact, many of the countries that have their GDP that dependent on the remittances, they started to understand this concept and allow and accepted Bitcoin as a legal tender. So the most famous cases was El Salvador. Ukraine also started to do that, and Panama is in discussion with the parliament to approve the draft. And then it comes an evolution of a blockchain. So the blockchain 2.0. And this type of evolution came from Vitalik Buterin, that is the founder, one of the founder of Ethereum, which is the blockchain 2.0. Many people call it like that. And the Ethereum is a fully versatile, censorship resistant, decentralized protocol that is designed for building decentralized application. And in order to do that, it brings an innovation here. It brings the possibility to have a Turing-complete programming languages on top of the blockchain. And this programming language allows the creation of smart contracts, that is the base unit, the core concept of the Ethereum blockchain, and create decentralized application that depends from the smart contracts. And a smart contracts, the terms was invented by Nick Szabo, is a computer transaction protocol that executes terms of contracts. So it's a very simple terms, but it gets a lot of power if it's applied in a decentralized network like the one of Ethereum. So the design principle of Ethereum is quite simple. So they train for simplicity. So the entire protocol is simple and auditable by people. So the programming language is at the base of Ethereum. It's called Solidity. And it's designed in a way that it's possible for people to review it. It's universal. So you have transactions that work universally among the network of Ethereum. It's modular. So they also call it the money Lego, because they can take and create modules and stack it on top of each other in order to create more complex application. It's agile in the sense that the community understand their own demands, understand what are the challenges, and modify the protocols in order to meet those demands. And it's not discriminatory, or there's not censorship in that. So there's no any single members of the Ethereum network that is able to censor a transaction or eliminate someone from the network. The concept of Ethereum here that is differs from the one of Bitcoin is the state machine. So you have a state that reads a series of input and creates an output state. So a transaction is essentially modifying the state of the overall Ethereum blockchain. So instead of maintaining the transaction, so the amount of money that each one has, I maintain the amount of money, but also maintain the state of the blockchain. And this differentiates from Bitcoin. So Ethereum is a balance-based ledger, why Bitcoin is a transaction ledger, because of this reason. Bitcoin only has the transaction inside, while Ethereum has state plus balances of the overall wallets. And the good thing is, like, I can send a transaction, and they also have a similar concept with Bitcoin. So in order to reward the people that maintains the network, so those miners in the Bitcoin network, I can then reward them with something called gas. So gas is a monetary unit, as a unit of account they can transfer to the miners. And then I finish the transaction and I consume a certain amount of gas, and the gas that remains goes back to my wallet. Another thing is that the blockchain is an isolated machine. So it lives inside himself. So in order to interact with the blockchain, you need to have an externally owned account that pushes the blockchain and triggers something inside. So the externally owned account sends a transaction to a contract account, which is essentially a public key, a public address. The transaction is triggered, and then I can link that transaction with another contract account. And here's the concept of modularity. I can do this several amount of times and create complex logics on top of that, even though the overall programming language of Ethereum is very simple. And this will come back. So the fact that the transaction on top of a Ethereum network or a blockchain in general are triggered by an external account will come on end afterwards in this presentation. And you might think, like, okay, like, what kind of applications we can do this? We have a simple programming language, is Solidity. We have modularity. So we can, and we have decentralization. So what we can start doing is to start to decentralize application in the centralized finance world, in our financial world. So you have the concept of commercial banks, like HSBC of Bank of America, and they have their own counterpart. So you have P2P lending protocols that are decentralized and work without employees. You have exchanges like the New York Stock Exchange or the NASDAQ, the NICE or the NASDAQ. And then you have the counterpart, so decentralized exchanges like Uniswap, that has been doing $1 trillion of volume, 0x, QuickSwap, SushiSwap, or a myriad of applications. Each one of these applications is open source. So people that developed application here, they can then take reference from other smart contracts and then create their own innovation. And this is completely open source. So the speed of innovation of this space is something that unheard of. And then the final part is the reinsurance or insurance companies. You have AXA, Allianz, Zurich Re. They're starting to be replaced by decentralized insurance protocols, such as Nexus Mutual, that is the #1 decentralized insurance protocol. Like the protocol that I'm building, Ensuro, we're still small, trying to get there. Pre-Scalbor, and a myriad of, and a plethora of different type of protocols. So right now I'll show you a website that is quite interesting. It's called DeFi Pulls. So DeFi Pulls tracks all the different type of DeFi protocols and tracks the money that are locked in this. Currently, we're sitting on $90 billion only in the Ethereum ecosystem. $90 million that are sitting on top of decentralized protocols that are in a decentralized network that can be accessed by everyone. So at the top of this, you can find AAVE, which is a decentralized lending protocol. Curve, which is a decentralized exchange. MakerDAO is trying to replace a dollar. So I can use highly volatile currencies as a collateral in order to create a currency that is pegged with the value of the US dollar. I can create a derivative exchange. I can create a payment system. I can create insurance, reinsurance system. I can create options. I can create any type of product coming from the simple concept of the modularity, but this greater concept of decentralization. And the number, I mean, if you can go back to 1 year, it's or a little bit more. So it started from 0. So $700 million in 2017. And right now we are $90 billion after a couple of years. So it's extremely fast pace environment. So right now I'll show you one example of a decentralized application. Let me get it here, which is called Sushi Swap. So we can see with our own eyes how a decentralized protocol works. So what I did is I installed MetaMask in my wallet, in my browser. So MetaMask is the most widely adopted wallet, decentralized wallet around. And then I can interact with the decentralized exchange. And in this case, what I want to do is like, I want to convert the underlying token, high volatile token, that is a MEDIC, for another token that it's in, that is a token much more stable. We call it stable coin. So a stable coin is a token that sits on top of the blockchain that is pegged 1-to-1 with the value of the US dollars. So it doesn't, it's not affected by the fluctuation of the different currency, but it follows the US dollar. And in fact, I can take at any point of time these US dollars and convert it back to US dollar, USDC, and convert it back to the US dollar. And what I will do here is like, I already connected my wallet, and then I want to convert 0.5 MEDIC for the equivalent amount of the USDC. Then I go there, I see that the transaction is, with this current price, and then I swap it. I confirm transaction. The transaction triggers my wallet. I confirm the transaction, and now I change my highly volatile asset for a stable coin. And these stable coins can be transferred in a matter of seconds to any people in the world. And this will come in end afterwards. So we go back to the presentation. We see DeFi Pulls, then we see how to use DeFi protocols. And now now that we have this concept in mind, we can go and start to understand how we can apply these several different concepts in the insurance space. Everyone can invest in a protocol, and everyone can access to these stable coins, the USDC, for example. So I can take different type of liquidity providers, and I can let them invest these stable coins inside a liquidity pool. So a liquidity pool, it's a pool of capital that is governed by smart contracts. I can create a program written on Solidity, and I can set some rules for this pool in a way that they respect the code that I wrote. And the liquidity pool sits on top of the permissionless blockchain. In this case, is Ethereum, or MEDIC, which is on top of Ethereum. And the capital collected here, it's used to provide insurance capacity to risk model providers, MGAs, especially in the parametric insurance space. Why we choose parametric insurance? So parametric insurance, you have a preset payout and deterministic triggers. So the preset payout enable us to, whenever we receive a premium from the different risk model providers, to receive this premium in the liquidity pool and algorithmically lock a certain portion of the capital in order to guarantee solvency. And in the protocol that we're using, we're following the standards of the Bermuda Solvency Capital Requirement, which is the same as the Solvency II, as I see in the course that you guys are studying right now. The capital gets locked to maintain solvency. And if there's a trigger, the trigger interact with the smart contract and unlock the capital inside the insurance liquidity pool, and then the capital is transferred to the policyholder. And parametric insurance is pretty much everywhere right now. We can do flight delay. You have a binary option. Is the flight canceled or delayed, or the flight on time? And then I trigger a policy. Is the hurricane inside a certain path? So is the cat in a box, as they call it? Yes or no? And I can trigger a policy. Is the crop getting dry or suffer from drought or any other problem? I can monitor from a satellite, check the color, and trigger a policy. Is the location flood with, there's water in this flood? I can check a satellite and determine a trigger, and then trigger the smart contracts and release the funds. Now, another thing that we're doing here, it's since we're based in a permissionless blockchain, then we access to this money Lego that I explained before. So you have a composability of different systems and the accessibility to the vast world that I showed before. Instead of reinvesting the money in asset management system that is usually puts money in a fixed yield product that right now has a very low interest rate, I can put the money in that decentralized protocol that borrows the loan in an over-collateralized fashion. And then we will analyze that. I invest the money over there and I collect interest. The good thing about this protocol is that they have instant liquidity and they accrue interest on a second-by-second basis. So I invest over there. Every time I need money, I trigger the transaction and I collect the money, and I use this money to provide insurance capacity to the policyholders. And another thing that is happening here is that what's happening is that risk model providers and insurtech companies usually have an information asymmetry from their insurance companies or the company that provide capacity. So the company that provides capacity doesn't want to lose money, so it's very risk adverse. And the company that sells the policy wants to sell as many policies as possible because its revenues are dependent on that. So you have this type of fights, and at the end of the day, the risk model providers is the one that contacts the policyholders. So it can maneuver this type of policies and in a way that maximize their revenues. And the thing is that in the way that reinsurance is structured right now, the overall performance of the MGAs are sent back to the reinsurance company in a monthly basis or a quarterly basis. So you have this information asymmetry. And in blockchain, you can solve that. So you can track each single policy for each single MGAs and have the transparency of the blockchain at the bottom. And on top of that, you can put another component, another module, which is a quality assurance system, which is essentially a machine that sends test policies in order to validate results. And that's what Ensuro is. Then we want to analyze one concept here. So if you have an externally owned account that triggers a policy, and then this externally owned account is the one that essentially is in charge of being the trigger agents of a parametric policy, then over there you have a problem. So you have a large amount of cash that is controlled by a single entity. And that goes against the concept of decentralization and can create a lot of problems. So there's a nice concept in blockchain called oracles, that what they do is extending the numbers of externally owned account that they can trigger a transactions. So there's a company that is called Chainlink, but there's several different companies. Chainlink is one of the biggest. That what it does is like aggregates transactions on the network, and then perform a certain computation based on the smart contracts, and then trigger a smart contracts on top of the blockchain network. And that smart contract and then trigger another network in another blockchain. So that's called oracles. And the oracles are the tools in the blockchain that connects the real world data with the blockchain, because the blockchain cannot communicate with external world. So it always need to be triggered. And then we have other type of examples in the decentralized insurance space. So as you might seen in the DeFi Pulls, you have this company over here that is called Nexus Mutual, and currently owns $561 million of assets. This again is a decentralized protocol that sits on top of a decentralized blockchain. They use a different type of concept compared to the one that Ensuro is using. So Nexus Mutual uses token economics. So as Bitcoin has a certain unit of value, Nexus Mutual has a certain unit of value that is enclosed in the NXM token. And the NXM token uses a continuous token model or a bonding curve. What it does is that it links the total funds in the mutual with the actual price of the token in a curve defined by the protocol creator. So it links de facto the minimal capital requirement with the amount of with the price of the token. I can if there's a certain amount of cash in the protocol that is above the MCR, the price of the token increases. If the price of the if the amount of money in the minimal capital requirement is below a certain threshold, the token drops. And in theory, people will need to be incentivized in order to purchase tokens and increase this minimal capital requirement. So what they did smartly here at Nexus Mutual is that they connected the value of the token with the actual overall minimal capital requirement. And the minimal capital requirement is also dependent on the policies that you underwrite. So the more the protocol is underwriting policy, the more money are then inside the MCR, the more the token gets valuable. If the token gets too valuable, meaning that there's too much money in place, then what I can do is like I can redeem my NXM token in a way that I can take the underlying collateral and reduce the MCR. So they use this token economics incentive as a way to maintain always the price of the, or like maintain the amount of liquidity in the protocol in balance with the numbers of policies that are sold. And this goes and solve some of the problems in the insurance space. What's happening in the insurance and reinsurance space is that reinsurance companies go in a private equity round, or they go IPO, and they're trying to maximize the numbers of money, the amount of money that they raise. This money that gets collected in the balance sheet of the reinsurance company, and then the reinsurance companies goes and trying to source business. But if you have a market downtrend, you have a lot of fluctuating capital there that is not used. So the companies then rebuy the shares as a way to maximize the profit from the shareholders. So they use this mechanism that at the end, it's extremely complicated and it's extremely cost ineffective. So blockchain can solve some of these features. So I finished my presentation. If you guys have questions, I'll be happy to answer. So I left my email here. So feel free to send any type of question there, or feel free to ask here, or you can also add me on LinkedIn. Thank you.
Okay, so now we're open for questions. You can either unmute yourself and ask Marco yourself, or you can leave them in the chat box. All right, so Marco, maybe let's just get started. So let me throw out some questions. I find it very fascinating to learn about your business model, and so I'm actually thinking about the difference between what you're proposing and that Nexus model, right? So Nexus model has this very interesting way of linking the token price to the sort of adequacy of that of the minimum requirements, capital requirements, and so that's a way to ensure there will be sort of an adequate supply of capital. But in your model, it's all driven. It was all promoted as a sort of investment opportunity, right? So there's no direct mechanism to attract more or less capital. So how do you deal with that?
Yeah, so the way we're solving this is to source as much MGAs as possible, and to make the interest rate of the pool attractive. So what we notice in the ILS market is that the return from the ILS are around 2 to 3% on an annual base. If we source good business on a parametric model, we're able to get 10% of returns for the liquidity providers. Plus, we're able to tap into the AAVE protocol that I forgot to show in my presentation. But AAVE Protocols is a protocol that it's actually I can do it here. AAVE Protocol is a protocol that has a 4% interest rate at the moment, and it's able to provide 4% interest rate because they don't have any type of operational cost. So you have a bank, pretty much, that it's that it holds $25 billion and no employees behind. So you remove a lot of the operational costs that are like linked with the banking infrastructure, and are able to give certain returns back to the users. So currently, if you check the Polygon market, which is the market we're using, you have an interest rate that it's for USDT equal to around 4%, given by 2.61% plus something that they call liquidity mining process. And we can also, right now that as you remember, we bought some USDC, I can show how it works. So I can open the different system, and the different system has the rate of utilization of the protocols. So I have a certain amount of token of USDC that are borrowed, and a certain amount of liquidity. If the amount that is borrowed goes high, then the interest rate of returns goes high, because I want more people to provide liquidity. If the amount of available liquidity gets too big, then the interest rate decreases. So in this way, like, people are incentivized to remove the protocol and find for additional like alternative source of capital. Then I can go here, and then we add like 90 cents from the protocol. I can go here and then deploy. So I can approve the transaction. It will trigger the MetaMask account. And after I get that, I have instant liquidity. So the transaction gets pending because the transaction is to propagate inside the network. I then deposit money, and the money that I deposit increases in value second by second basis. So that's something that, okay, I'll finish the UX and UI of the blockchain is very, very early. So we are even though we are $19 million of volume, like, we're still extremely early in the system. So the transaction is being confirmed, and now I have my AM USDC tokens that are inside my browser wallet. And then I can go into my dashboard, and I can show that right now I have collateral are $90, and my balance is supposed to increase. So we have 493 right now. If I update the page, I should have something bigger. So that's something that, like, a Nexus Mutual still not there. So it's something that Nexus Mutual it's not using. Okay, here it is. We have 493 before, and now 809. So the interest rate is accrual second by second. And this is on top of the Nexus Mutual model that it cannot be tapped. And another thing is that, still increasing. So the model of Nexus Mutual is a discretionary mutual fund. So they use a discretionary mutual fund because they remove the legal necessity or the legal requirement for an insurance company to sell to pay a certain claim. By removing that claim, they have this sort of a discretionary mutual fund that enables the participant of the mutual not to pay a certain transaction. And what the people in Nexus says is like, okay, if people start not to pay transactions, then the value of the token will go down. But if the value of the transaction is quite relevant, you might have an adverse incentive that push the people to not to pay a claim. So the guarantees of the contracts are weaker. So that's one of the other points that we're bringing here. But to answer your question, right now we are trying to source as many MGA as possible to make it very appealing for investors to jump in. And we don't have a token to distribute this revenue, but we make the system regulates by itself. So if the business is is interesting, then the capital will come in.
And what information do you provide to the investors then?
So the good thing is that the pricing of each individual policy and the interest rate of the protocol are publicly available on the blockchain. So everyone can go in a system like Etherscan. There is the blockchain explorer, and then you can check any type of information. So right now we use AAVE. In the future, we will be able to use a scan of ourselves and then understand each type of information related to the system. You can monitor the contract. Oh, okay, this doesn't work. So you can check all the people that hold the tokens, and you can understand the type of interaction. So you will be able to get the actual interest rate in a way that is transparent. That is one of the things that we notice in the reinsurance world. So reinsurance world is a very not transparent system, in the sense that you have a different type of competitive forces, and the reinsurance players tend to hide their actual returns. In blockchain, you don't have this problem anymore, because each time you put something, then it gets recorded, and it's like one of the benefits of complete transparency. In this case, we have someone sending money to the wallet, and I can go and check the amount. I can check that this contract interact with the sushi swap or other type of products, and then I can see the amount, and I can even check how much money each one has inside. Or the smart contracts hopefully works. Okay, now it doesn't work, but in general you can check this smart contracts, because the smart contract is publicly available. So that's one of the things that the blockchain is bringing, using sushi swap to see if there's the ability to check. Okay, yeah, you are able then to check the different smart contracts and understand what type of things are doing there. Here it is. So each code in the blockchain, it's public. As I say, like, it's driven by the open source community. So you can check all the codes, you can check all the interest rate on top of the protocol. So that's what we're bringing as a natural consequence of being built on top of the blockchain. So every economic information is then shared with the users.
Mm-hmm. But the investor would still have to sort of understand the technology enough to be able to extract all the information, like all the dealings you have with the MGAs, right?
Yeah, one thing that we are solving like that is that you will be able to understand when the certain economic relationship started with the MGA and when it ended, and the type of performance that the MGA had. So if you have a large loss ratio that was not calculated in the premium, then you will lose a lot of money. So the amount of MCR in the system will get reduced. So you can see that the pricing of the system is not well calibrated, because you see that the amount of money gets reduced. Or you see that on the other side, someone is making a lot of money in the MCR. So it's overpricing, which is good for the liquidity providers. So the type of information that a general user will need to know, I believe, will be limited to the type of returns that will be able to make. And this is driving a lot of the different protocols in DeFi. So people are using extremely complicated and exotic derivative products, and they just invest there, and is a way to accrue interest. And we believe the same forces will apply in the protocol, as is applying pretty much everywhere in the DeFi world.
So what information do you provide to investors about the potential losses then, right? Because when when they park money in your protocols, and then they obviously they're anticipating higher than expected, financial returns than some other protocols, but then they're also subject to potential catastrophic losses, right? So how do you protect them from the downside?
So what we're doing is we are, as a reinsurance company, we're aggregating different type of risk. So diversifying the risk of the portfolio. This is in a way enable us to have a better optimization of the solvency capital, and in another way prevents people from catastrophic losses. We're currently also on algorithmic level operating on a solvency requirement of 99.5. So we will need an event like in 200 years in order to wipe out the entire protocol. So the same type of incentive that insurance has, then it's are applied in the blockchain, with the difference that I don't need to wait the financial report of the insurance company, but I can go and jump in and get it. So what's happening is like a lot of projects are starting to enable explorers and enable interaction with the community in a way that it's all transparent and in a very well consumable form. And as a matter of fact, recently, I mean, not related to Ensuro, but recently we see Societe Generale, one of the biggest financial institutions in the world, that is starting to interact with a MakerDAO. So a financial institution with 150,000 employees started to interact with the MakerDAO and operating in this type of protocols. So we will see, I mean, 80 or 90% of the capital is owned by institutional right now. So we are still small because institutional are not coming into the space, but institutional are much more complex type of individual. So those are the type of individual that will dig deeper into the performance of the different protocols and deploy significant amount of capital. So that's what we're waiting, and I think as an industry, everyone is waiting.
Okay, and do you have any plans to bring insurers, like traditional insurers, into this to cover your extreme events or something like that?
Yeah. So what we are discussing is to have a traditional reinsurance to cover the loss, the extreme losses in the protocol. So you can monitor the amount of SCR in the pool, and if the SCR drops because of a catastrophic event, then a reinsurance company can deploy capital inside the pool. And another thing that it's happening is like there's interest from incumbent reinsurance company to participate in this type of products, because the traditional software stack that they're using is too outdated. So for them, it's convenient to deploy capital somewhere else instead of spending hundreds of millions of dollars to update their own infrastructures.
Okay, so I guess maybe I will ask one more question on behalf of our students then. So how, if they wanted to learn more about these DeFi applications, right, where can they get more information? And then let's say if we have student entrepreneurs who wanted to have their own, developing their own protocols, and where should they start? Yeah,
so I've been in the protocol, as you can see, there's some reference for a very well done documentation that has been done by the legal counselor of Ethereum. So it's called GY's Cryptocurrency and Blockchain Compendium. There's around 600 pages for DeFi. I can share it here. I can probably share, trying to find the link here, and I can share it with everyone. So that's a very well done documentation. And another thing is like you can find a lot of courses online. So I think Berkeley University start to do like an open courseware for blockchain. You can find a lot of developers that are extremely helpful. So they generally like stay around Discord or Telegram or the different type of community like Stack Overflow or Ethereum Research, and you can find interesting type of information there. So the version is this one, and the link is this one. Get it here, and I definitely gotta recommend to check it out. So it's one of the best documentation I came across in these past years. And then another thing is like there's a large amount of data and about a large amount of information in YouTube. So if you want to not to like for example develop your own protocol, or if you want to interact with the protocols as I did right now, there's hundreds of video or even thousands of video you can access and learn. And then once you start to understand how the protocol works, then like the code itself is not complicated. So, and there's an increasing interest. So a lot of people that I know started to jump in the space.
Okay. All right. Is there any other question from the audience?
Can I ask one question?
Yeah, please go ahead.
Hi, Marco. Thank you for the great presentation. I really like your description on that people think blockchain is the future, but cryptocurrency is a scam. So with your expertise, what do you think are like the most important part to make people think, to make people see the potential on the blockchain, but don't trust the super currency, and maybe what we can do to help people like break down this myth?
Yeah, so I believe like what happening with the blockchain ecosystem is that it was a very small community of anarchists at the beginning. So they got it the crypto punk, or they were trying to revolutionize the system. So they started to as a way that they went against the traditional institutions. And another thing is that the high fluctuation of cryptocurrencies derived by the fact that the initial volume of the currency is not large enough. So you have, for example, gold. It's a huge like I think 800 trillion or 80 trillion. I can't remember the exact name, but it's a huge like a pool of capital. So in order to have a high fluctuation of in the gold price, you need to have very large movement. And in the beginning of the cryptocurrency history, the volume was very small. So people were seeing this type of this fluctuation. Now it's changing. So you see that the price of Bitcoin is kind of stabilizing, and that brings trust. Another thing that it needs to be done, it's a lot of work around anti-money laundering and anti-terrorist financing. So initially, Bitcoin had a bad reputation for being the currency of the dark web. So a lot of the Silk Road or the different type of e-commerce were using Bitcoin for different transactions, which is very bad idea because everything is recorded. So then they moved to other type of currency called but it's so, and that it was possible because there was not enforcement of anti-money laundering or anti-terrorist financing practice. That on my personal point of view, they should be applied at the cash out point. So whenever I have a cryptocurrency and I want to convert the cryptocurrency for goods or fiat, then I can apply a certain AML. And the good thing is like I can track back each single transaction. So I can understand what the people, where the money went in a very transparent fashion, which is impossible with cash. So that's one of the aspects. And another aspect is to bring more and more institutionals with the use cases that can apply to the actual world. So, I mean, we're trying to do it in a regulated fashion with the parametric insurance, and they can be applied for micro insurance space. You have the Societe Generale with a MakerDAO deal that is bringing a financial institution in a decentralized currency, in a decentralized stable coins that brings more and more trust. So it's a matter of time, even though it's one of the fastest market I've ever seen and I've been in.
Thank you. Thank you.
Oh, no worries. Thank you.
Okay. I think we're oh yeah, please go ahead.
Marco. Yeah, sorry. Yeah, Marco, can I ask a question? So,
Sure.
thank you for the presentation. And just one question about so in smart contract, I think a big problem is that especially in insurance, you know, a lot of times that the trigger relies on events that happen in the external world. So that's why you also mentioned about the oracles. So how and however, like based on my understanding, the issue with oracles is that you cannot always guarantee that they are honest and trustworthy. So I wonder how you Ensuro address this issue.
Yeah, so there's several different Oracle providers. So I can take two examples. The first example is one of the biggest provider called Chainlink. And Chainlink, what it does is like it aggregates different type of parties and that they perform the same type of computation. So let's suppose I have a flight delay information. So I want to check whether or not the flight from Taipei to Chicago is delayed, and this public available information is in a public available API. And what I do is like I recruit several different parties in n different parties. So it can be 10, it can be 20, it can be 30. So the more I'm concerned about the reliability of the information, the higher the numbers of people I will ask to perform the same computation. So these parties, these n parties, they will go to the public API, fetch the information, produce a hash of the data that they gather, and then the protocol by itself will compare all the different hashes and take the majority. So the hash that appears the majority of the time is the hash that will be used for triggering the smart contract. It can be the majority or it can be the absolute majority, so 100% of the people. So that can that's how it's been solved by Chainlink. Another project that is also interesting is API free, which is a first party Oracle, they call it. So it's an Oracle that embeds JavaScript code in the database of the data provider. So in this case, weather.com, for example. So they embed this JavaScript code inside the weather.com server, and then this JavaScript code, this tool that they developed, received cryptocurrency as a transaction, and what it gives as output is the data that have been searched for. So it grabs the data and publishes it on the blockchain. So in that way, you're essentially, if you have a very well audited tool that is open source, then you can make sure that the first party data provider, it's honest, because everyone depends on the first party data provider. And then you can take the information over there. If you're not satisfied with that, you can take different type of data providers. Take weather.com or I don't know, Apple Weather, or a different type of data provider for weathers, and aggregate the information on top of smart contracts that operates on chain. And then I can perform computation on top of that. So it's a problem, and it was unsolved for a bunch of years. So remember in 2017, 2018, there was a problem still unsolved because there was not enough tooling to solve this kind of issue. But right now it's getting solved. So you can have off-chain aggregation of the data, and then you can trigger smart contracts on-chain.
Okay,
so,
thank you, Marco.
No worries.
Yeah. Thank you for the explanation.
Okay, I think we'll pass the time, and then it's fascinating.